All right. So we usually wait for people to come at around noon, between noon and 12:05 Pacific time.
Awesome.
Last week we maxed out the room. We had 99 people in here. So we'll
Whoa.
see what we do this week.
Awesome.
Yeah, which is really good considering Intel has been going through a rough time. And I think, as you know, that this club started off as the Intel Real Estate Club, an
hmm
employee real estate club, and it's gone through quite a bit of transition as Intel has apparently gone through transition as well.
I think everybody's going through transition right now.
Yeah, people are no
Awesome.
longer saying survive till 25.
Right?
It was a thing for
Can
a
I go
while.
ahead and share my screen, or do you want
Yeah,
me to?
yeah, go ahead. I'm going to kick it off with a couple of announcements, but feel free to share your screen. Yeah,
Awesome.
actually, I don't really have any announcements now that I think about it. We have a conference which we're planning, but it's still kind of in the planning stage.
Very cool. Very cool. Well, would love to,
Hmm.
discuss that further whenever you got details to
Yeah,
share.
yeah, absolutely. Oh, are you scheduled to speak in a week or two also? I had a speaker that was duplicated. Maybe that wasn't you,
So today is an investment pitch, and
right?
then in January I'm doing and more education focused.
Gotcha. Okay,
Got it.
that's fine. That's far enough apart. I had a person here that was scheduled. Um, they scheduled and then they scheduled another in 2 weeks from their meeting.
Oh wow.
And I usually want to space it out by at least 2 months before we have repeat speakers.
Totally, totally. Nope, was not me.
Okay.
I don't think so. Let's put it that way.
Okay.
I don't think so. I
Hey,
don't have it
everybody.
on my calendar.
I see we're getting a few more people in the room here. We're going to kick it off. Well, we'll probably wait till we have at least 40 or 50 people here. But welcome. Welcome to the group here. If you're joining us for the first time, go ahead and put that in the chat. No matter how many times you've been here, and I know a lot of you have been with me for years. Actually, put in the chat how long you have been attending the Alternative Investing Club. I would love to know that because sometimes I'll meet somebody new and they'll say, "Oh yeah, I've been attending for 3 years." Welcome, Addie. First time. By the way, and this is why I should have announced the conference last week. Last week was actually our 7 year anniversary of this club operating. So it was founded 7 years ago last week. Um,
Congrats.
yeah, four of which was internal to Intel, and about three of which now is out in the public. All right, so don't recall a long time. Yeah, Henry, I know you've been here a long time. Um, 5+ years, maybe, maybe. Welcome, Todd. Good to be here. How many of you are here because of Sparkle Rental? I know that they sent out a message on our behalf a couple days ago. I'm kind of curious about that as well. About 2 years, first time, less than a year. Wow, we've got a lot of first timers in here. Sometimes I forget that. Sometimes I think the audience knows all about real estate syndication because we've been talking about it for so long.
hmm
5 years, Keisha. I know you're a regular, shall we say? I almost said old timer. I don't think that would have been good. No. Brian, not old, not old. My son, I hurt my back last week. True
Oh
story. I've hurt my
no.
back. I've been kind of limping around, and I have a back injury for those of you who know me for a while, and it kind of goes out every once in a while. My son, who's now 14 years old, said, "Dad, you know, are you limping around because you're old?" And I went, "No, no, no, no. I'm limping around because I hurt my back." And then he looked at me and said, "Why do you have so many gray hairs?" Thanks, kid. Thanks a lot.
Are they a teenager? My teenager does that to me all the
Yeah.
time. She's like, "You're old." I'm like, "I just ran up a 14,000 foot peak. I
Right.
can't be that
Right.
old."
Right. And I have looked back at some of our earlier meeting pictures. 7 years ago, I didn't have any gray hairs, so that was kind of a revelation for me as well. All right, we've got a quorum here. Hello, Fang. Great to be here. I'm always going to call out Fang if you need CPA's tax services in the California area. Um, oh, you're here for Whitney. Well,
Oh,
great.
hi. Hi. Whitney has a weekly on Tuesday, so I was a regular there too.
Oh, okay, great.
She,
Yeah.
she asks amazing questions. So I can always
Yeah.
rely on her. Anytime I say, does anybody have any questions? Yes.
Yeah. I keep her longer for last minute questions.
Well,
Hey,
since there are so many new people here too, I have to thank Fang all over again. Was it 2 or 3 weeks ago, we had a miscommunication and a speaker didn't show up, and Fang stepped in and just answered tax questions the entire hour. It was great.
Yeah, that was lovely. Sorry, I just exercised, so I'm so sweaty and red, so I'm not gonna show my face.
All right. Well, I think we've got 55 people in the house, so let's just kick it off. First of all, welcome to the Alternative Investing Club. We meet every single Friday at noon, and we've been doing so consistently for 7 years now. Um, and I think this year we've missed a few more than in other years, but prior to this year, we're at like 40 on average for 46 meetings this year. Prior to this year, we were doing 47 meetings a year on Friday. So almost every single Friday, usually not after Thanksgiving, usually one or two in December, and but otherwise we're here. So we're here to learn from the best speakers in real estate and private equity investment. A couple of years ago, our club actually expanded its mandate. We started off as a real estate club for Intel employees, and now we're out in the public. And maybe 2 years ago, I sent a poll out to the group, and after they asked me to do this, they said, "Why don't you send a poll out into the group and ask if people want to expand to educational topics, you know, around more than just real estate?" And so since then, we've started talking about different private equity funds, oil and gas, debt validation, different types of. We had a group come in and talk about how do you syndicate an airplane. And then lease, yeah, that was a really fascinating. Did you know that when you're sitting in a 737 or a 747 from Delta, that there are actually investors that own fractional interests in each of the engines on that plane? And you can go out there and find funds that will invest in fractional interests of planes and plane engines. So that was a fascinating talk. But we had somebody come in and talk about creating a fund around art. We had a person come in and talk about creating a fund around high-end whiskey and wine. So there's all sorts of interesting ways that you can privately invest. And honestly, the more you learn on the subject, the more creative you realize that the subject can be. And so that's why we're here. We're here to learn from the best every single week. And speaking of the best, Whitney, I think you're now tied with somebody for speaking the most number of times at the Alternative Investing Club. I think you've spoken 3 times here, if I'm not
this
over
is
the
my
past seven
third,
years.
and then oh wow, and then in January, right?
Yeah, yeah.
Keeping the race on. Awesome.
So,
Thank you.
and
It's such an honor.
yeah, and it's an honor to have you here. Why don't you introduce yourself, introduce your group, which is well known within the investment industry,
Yeah.
and I'll let you take it away. And I'll watch the chat for you, so you don't need to. If people have questions, go ahead and put them in the chat, and we'll answer them for you. Oh, I guess I should also say right at the top here too. There are 3 ways that we bring people in here. The first way and the most common way is as an educational talk. They just come in for free. We try to find the best speakers, but the Alternative Investing Club neither endorses nor not endorses any of them. We're not a registered investment advisor. We're just a club of investors. And so we're listening to people, not giving legal, tax, or financial advice or recommending or disrecommending. The second way that people come in is they come in and give a paid pitch. And that's what we have today. We've got a investment presentation that's going to be coming in. The third way that people come in is if I've done due diligence on them and understood their investment, and we're bringing them in as somebody that the club fund will invest in. So the club does have a fund, and on occasion we bring speakers in that are top quality, and oftentimes they're in once or twice before for the first two reasons, and then we bring them back and say, "Hey, our club would like to invest with you." So, Whitney, welcome to the group here.
Well, thank you. It's such a pleasure to be back. And it's been a while, actually. So I'm sure there's several new faces here. So you guys are welcome. My name is Whitney Elkins Hutten. I'm the Director of Investor Education at PassiveInvesting.com. We are a private equity group that specializes in multifamily, express car washes. We have done self-storage and hotels as well. We're not finding that's the best part of the market cycle to invest in those two asset classes. Um, and then we also do real estate debt, which that's what we're going to talk about today. But I am an educator at heart, and so I can't resist stepping away from, kind of helping people connect the dots on why an investment is a good investment. Debt investing, period, because I see so many investors actually get into debt deals that are almost just as risky as equity deals. So buckle up. We've got 50 minutes. We are going to go for a ride today. But here's my contact information. I'm not going to leave you wondering until the end of the show how to get a hold of me. You can, best way, easiest way is to scan the QR code. You'll see it a couple more times through the presentation. That gets you right onto my calendar. You can also visit passiveinvestingwithwhitney.com. That's where the QR code goes to. And then you have my contact email there as well. Now, things that we cover today are for educational purposes only. So make sure you take everything back to your CPA, your lawyer, your advisor. Don't make sure anything that we discuss today actually applies to your position. That's the disclaimer. And now we can move forward. So a little bit about me. I've been investing in real estate since 2002. I've done it largely, in owned assets. I've scaled over 800 million in real estate and various, multifamily assets. That was my primary love, single family and then multifamily assets. Then I diversified out into express car washes and then self-storage units. But the backbone of what I did, I was working in public health, but I actually on the side was flipping real estate. I did about 5 million in real estate flips, and that's kind of was the engine behind my investing career. So probably spent the first 15 years of my investing career being very active. And then I went, hey, you know what? I have a husband, I have a daughter now, and I'm got a business and I'm working and how on earth can I like figure out how to get to financial freedom and retire? And it was really through my passive investments that I was able to unlock the kind of the golden handcuffs, right? It allowed me to double down on what I was really good at and then leave the other things to the experts. So I actually document this journey in my book, Money for Tomorrow. You can find that on Bigger Pockets or on Amazon.com. But really what that book does is that it documents my journey on how I utilized real estate to get one result, which is 100% control and choice on how I spend my time. Now, I still do an incredible amount of work. I probably work harder now than I did 15 years ago or even 10 years ago when I had all my single family rentals. And it's because I love what I do. I love teaching people like you, how can you go into a passive deal and, one, keep your time and attention on what you know and love. But two, how can you actually scale your financial freedom, simultaneously? And we can help you do that at passiveinvesting.com. Today we're going to talk about our PIC real estate debt fund, but we do have other investment opportunities. So this is your invitation to join the Passive Investing Club. If you join via passiveinvestingwithwhitney.com or scanning the QR code that you see, that gets you right to me. Of course, you can go anywhere on our website and get connected with our investor relations team. But if you want to connect with me directly, do so by connecting at investingwithwhitney.com. There we can hop on a call, get you connected to investment opportunities, and connect you to more information so you can get comfortable that you're investing in the right thing that matches your portfolio. All right, so we're talking about debt funds. Okay, specifically towards the end, we're going to be talking about our pick real estate debt fund. But again, I'm an educator. That's what I did in public health and in corporate training is that I have to start with what is it that we're talking about? What is a debt fund? I actually was speaking at an event last Friday in San Diego to a group of female real estate investors. And I had one person raise their hand. They were like, "What is a debt fund? I don't understand." I was like, amazing. This is a great place to start. So a debt fund is a essentially a pool of assets that so the fund itself raises money and lends money to real estate operators. Now they could be called borrowers or they could actually be called an operator. But when they lend the money, there's actually a note or a deed of trust that secures their position in secures the asset is backing the lending of that money. Now, we'll talk about the capital stack, different layers of money in a deal, and I'll show you where a debt fund enters into the picture. But there's some key advantages in investing in a debt fund versus going into an equity fund, like what you guys were talking about earlier. Multifamily investments, planes, wine, art, those are all equity investments. With a debt fund, you earn interest. Okay. So you're as close to being the bank as possible. You're depending on the position in the debt fund, you're going to be a priority in a case of default or deficiency on that asset. You don't have equity ownership into the deal, but sometimes the equity ownership actually complicates the structure as opposed to making it simpler. You don't have to deal with any of the management headaches. Like once you lend money, you're kind of out and you're just monitoring the investment as it goes along. And then of course, if you are owning your own single family, small, multifamily rentals, you don't have any tenant issues to handle either, right? You're literally getting coupons. Okay. I see questions coming in. I will promise I'll stay on and get all those questions cleaned up. If a debt fund's structured properly, the cash flow can be very predictable, okay? And it's very passive, okay, rather than owning an asset directly. So remember, a debt is you're the bank. A debt fund is that you have multiple investments where you're the bank. So why invest in equity versus debt? This is usually when somebody raises their hand or posts a question like in the chat box that says, "Hey, why would I go in a debt fund? Because I can get a higher return in equity." And I'm like, well, let's compare the two. It's not an either or. Should I go into debt or should I go into equity? I'm going to argue the case. You must have both in your portfolio, and we'll answer that question why. But when we talk about risk profiles, equity is higher risk, last to get paid in the deal. Debt is lower risk, first to get paid in the deal, depending on how it's structured. Cash flow, equity deal can have cash flow. Sometimes it does not. Oftentimes it does not, especially in this market. Debt generally does come with cash flow, usually monthly cash flow, or you can choose to compound it. Liquidity, when you go into an equity deal, you generally are locked up for the term, for however long the operator needs to operate that investment. 3, 5, 7, 10 years. I know, perma holds like 10 to 20-year investments. Okay, so there's no real way for you to get out of the investment. There's no liquidity. In a debt deal, generally, or a debt fund, generally you're going to have some sort of liquidity feature to that. And it's usually like a 90-day liquidity feature. Timeline for the investment. We already alluded to it. Equity is going to be 3, 7, years. If we're talking about multifamily real estate, it could be longer in down cycles. Okay. Debt deals generally 3 months to 36 months are going to be the cycle of a debt fund. And then you can go in and out of them. Return potential. Okay. Equity deals, I personally won't touch an equity deal if I don't hit a 1.7 or 1.75 equity multiple or higher. Why? Because I can go take my cash, go into an equity deal, or excuse me, a debt deal, and I can get a 1.7 return if I allow it to compound. So for me, the return potential, okay, if I'm going to take that risk in an equity deal, I need to be getting rewarded for sure. But again, remember, it's not about having either or position in your portfolio. It's an and, okay? And right now, debt funds are a tool to help you navigate the current environment and take advantage of what's happening in the environment. So why right now? Why are we talking about debt funds? Well, interest rates remain high. Yes, I understand the Fed has lowered, 25 basis points in the past week, and we're probably looking at a few more basis, probably another 50 basis points in the next like 4 to 6 months. However, bank lending is still the interest rate's still a lot high. I mean, there's still a lot of like uncertainty in the environment. And hopefully, we've all learned the Fed can lower interest rates, but that's not what drives mortgage rates. What drives mortgage rates is the 10-year Treasury, and the 10-year Treasury is still high right now. Okay, so that's the second part of this. Market uncertainty still persists and exists. And then based on what I'm seeing happening in the market, that's going to be kind of our ride for the next 12 to 24 months. Expect market uncertainty. Also, equity deals are still hard to come by right now. Good quality equity deals, especially ones that cash flow, are really hard to come by. All right, a lot of markets have yet to completely go through the hypersupply cycle. So they're still kind of on the downward slide. That's not the time where we want to get into them. We want to make sure that we're getting into a deal as it's either completely bottomed out, which is super hard to time, or it's coming out the other end. Okay, but the debt fund gives you optionality. Okay, so it deserves to have a seat at the table. Equity deals are slower and harder to underwrite right now. Rising rates, okay, guys, the 10-year or sorry, the Federal Reserve lowered interest rates. What happened to mortgage rates? Did they go down or up? They went up. That happened last fall too, whenever we had an interest rate drop. Okay, so there's still going to be some reshuffling here. All right. Your cash is sitting in the bank and probably on the sidelines. There's drag that's happening here that's eroding true wealth. Okay. A debt fund will help you bridge that gap if it's structured properly. So let's start talking about what it takes, to start looking at the properly structured debt funds. But the one thing I want to tackle first is for my naysayers here, they're like, equity or bust. Let's take a look at the market, right? Right now, we're mostly in the hyper supply. We're still seeing absorption. It doesn't matter what asset we're talking about, right? Multifamily, self-storage, industrial, right? We're still heading from hyper supply into the recessionary environment. It's in this part of the curve that credit is getting sucked out of the system. The banks they'll still lend, but you got to be the A player, the A plus player in order to get the lending. So this allows us as the investor, when the bank money is, sitting on the sidelines, us to step in and to solve some real problems. We can use our money to generate income, maintain flexibility with the dollars that we invest, and position if we go into the right debt funds, we remain positioned to where we keep that money liquid and flexible to where like, okay, when we start moving through the recovery into the expansion phase, we can now take some of those dollars and put them into equity, right? So again, it's not an either or, it's a tool to help you hit your goals and keep your money working for you. But the reality is so many people are really, really, so focused on equity for various reasons, right? They need tax benefits or whatever. They're trying to invest in one deal and get cash flow, equity growth, tax benefits, diversification, everything in one shot. And I've actually really changed my position on this, is that I think we have to look at the entire portfolio and see how the whole portfolio operates. And I actually had a recent client. She was a physician. She was investing in all equity deals because she needed the depreciation to offset income. She was trying to be a real estate professional on the side. And it really came back to bite her in the butt because when the interest rates rose, cash flow got compressed. Her assets were doing fine. These were largely owned assets. But when the cash flow stopped, she was like, you know what, Whitney, I am done. I don't need to ride the roller coaster of equity. Okay, that's fine. Hopefully those things will come back. I need to be able to have cash flow in my pocket today to, unhook these golden handcuffs that I have. All right. She didn't need any more tax write-offs. She needed optionality. So I would be remiss if I didn't point out the three-tiered fortress portfolio that I've been really driving home with our investors is when you look at your portfolio, make sure that you have all three legs on your stool. Because if we're missing a leg, what happens to the stool? It's going to fall over. Okay. You have to have liquidity, right? Make sure that you have capital set aside for your reserves, right? Emergency reserves, personal needs. Um, if your kids are going to get married in the next year, this is not the time to invest their wedding funds. Or if they're going to go to college in 2 years, this is not the time to invest their college funds into high growth assets. We want to keep things liquid and accessible. Okay. And we also need to keep a little bit of capital aside for opportunities. The second layer or the second leg of the stool is having a leg of the stool that is income generating only, safe, predictable, short timeline horizon. Okay. So we want to make sure that we are looking to build out this layer. It's when things get compressed, cash flow gets compressed on our equity property. All right, our equity investments, this is when we go, dang, I wish I had that layer in my portfolio that was just clipping a coupon and putting money in my bank. All right. Maybe you're that investor that invested in value add multifamily deals. And in between 2021 and 2024, you went, oh man, I got no cash flow. All right. This is where the debt fund comes in. And then absolutely, most people would do well to have a growth side of their portfolio. Okay. So again, this is not either or, this is a combination plan. But the problem is when people go into debt funds or even any sort of deal, equity deal, I see them actually spending more time, tongue in cheek, probably picking a mattress than they actually do, on vetting the fund. All right. There's a fallacy here that people think that if it's a debt fund, that they're in the safest position because it's a first lien debt fund and I'm golden. And we're going to pick that apart here in a second. But first, let's understand the capital stack. When we talk about debt and debt funds, we need to understand the different layers of money into a deal. Okay. So the debt fund is going to live in the debt layers of the deal. If you guys can see my cursor moving around. Okay. Now, and then the equity layers are going to be the upper part. Now, debt tends to be lower risk, maybe lower return, and equity tends to be higher risk, higher return. Okay. So this is where a lot of people stop and they go, oh, I see debt funds. It's low risk. No big deal. I'm going to go into it. But that's a fallacy. That's a risk that we're taking. We need to understand the structure of the deal in order to take this risk off the table. So when you're evaluating any debt fund, one, we want to understand the position in the capital stack. Okay, is it senior debt, first position lien? Is it second position lien? All right, is it not even backed by tied to the real estate at all? Maybe it's a loan, a construction loan to the company or an unsecured debt position. Okay, that to me like that goes past equity. Like we get really risky really fast. All right, so we have to understand the capital position. Where are you in the capital stack? All right, and there's different tiers here. So I would score any debt fund you go into. Where are you in the capital stack? What asset type is it? Is it residential, commercial, industrial, land? All right, residential tends to be everybody needs a roof over their head. Okay, there's a lot of borrowers and investors and tenants for residential. Not everybody needs a self-storage unit, okay? Not everybody needs an office, right? Those tends to be a little bit more risky. And then we get land, raw land. Those are really risky business plans, okay? Development phase. What phase of development is that asset in? Is it, stabilized? Is it distressed that needs a little bit of love and rehab to it? Or is it more deep value add or ground up development? Okay, understand the development phase of that deal. And then legal structure. How is it put together? Are we lending directly to a borrower? Am I lending directly to Daniel and writing the note on his house? Or am I lending to Daniel's LLC, which is a little bit removed, okay, a little bit more risk? Or am I lending to Daniel's blind fund, right? So again, each of those, the legal structure introduces risk. So this is kind of a recipe. The more parts of the recipe that we can have conservative in nature, the more conservative our debt fund is. The more ingredients of the debt fund that are risky, the riskier the debt fund is. Does everybody kind of see that? Awesome. All right. So at the end of the day, people are like, Whitney, give me the cheat sheet. I see what you're saying. I understand I need to put together my own due diligence tool. Thank you for sharing that. But where are the 4 things that I need to look? Make sure that any debt fund you goes into, I mean, if it's the danger zones where people really get tripped up, weak underwriting, excessive loan to value on whatever asset is being lent on, uh, poor recovery plans, meaning there's only one way for the lender to get the asset back, which is foreclosure. We don't want that. We want to see multiple ways that that lender can get the asset back. And then we also want to make sure that we're investing with lenders that actually have a really solid monitoring plan. We don't want somebody lending out capital and then, and it be like a 6-month or a 9-month note on the deal. And then they're checking in with the borrower at 5 months and 29 days going, hey, are you going to close tomorrow? We want to make sure that they've got systems in place to where they actually know the borrower's in trouble before they know they're in trouble. Okay. So when you get in risk with debt funds, it's probably because more than likely it's bad structure in the deal. All right. So those are kind of like our stumbling blocks. I mean, that's the 4 different areas that we need to really dive into on a deal. Like if we're looking at a deal, the kind of the recipe of it, the 4 big ways that we could really get into a deal and it gets screwed up really fast. How do we underwrite a deal? Okay, and I'm going to use our debt fund as an opportunity to underwrite. So again, I am an educator at heart. I'm not the guy that comes or the lady that comes in and says, all right, here's our fund and wheel and deal. I want you to walk away with real value here. So this is my 3 piece framework. Okay. In any deal, but we're going to use this for debt funds, we need to understand the people, the process, and the protections in place. So, people, who is the person raising the capital? Who's the person lending the capital? In a debt fund, you have 2 operators to underwrite, not just 1, but 2. Okay. Is everybody's interest aligned? At the end of the day, all of our questions in this area are trying to figure out, are our interests aligned, or is somebody trying to pull the wool over our eyes? Process. Okay. What is the process in a debt fund? Okay. In the debt fund, the lender is what is their borrower screening process? Okay. How are they vetting that borrower is a good borrower? How are they evaluating the value of that asset? Okay. How do we know that the loan to value is not too high? How are they, establishing value, both in today's dollars and in tomorrow's dollars, if there's a rehab business plan? What is their process around monitoring the asset when money gets lent out? And then when a borrower doesn't pay, because I guarantee in a fund, it's not a matter of if, it's a matter of when a borrower gets in trouble, how are they managing defaults? Do they only have 1 exit strategy or they have like 3 or 4? All right. And then protections. How are they protecting the note position or the monies that are going into the deal? Okay. What position are they in the capital stack? Me, I love first lien position. I don't touch anything else. I know I can get a higher rate, but if I am going to take on that risk, I would rather get into an equity deal, to be quite honest. I'd rather go buy my own piece of property. For me, debt funds is meant to do one thing: generate predictable income in my portfolio. Protections, conservative loan to value, right? If the lender has to take the property back, is there enough value to where they can actually sell the property off in the current condition and at least break even, if not make a little bit of money? And then guarantees, all right? Are they is the borrower having to put up some sort of guarantee, like a bad boy carve out, or are they having to bring capital to the table? Are they having to pledge other assets in order to secure the loan? And then backup plans. Again, we don't want to see just one way to exit the borrower. We want to see 4 or 5 different ways to exit the borrower. So to dive in a little bit deeper, here is some of my criteria when I ask these questions. Like if I am going into any debt fund, I want to see a minimum of 10 plus years of experience lending specifically in real estate, in the asset that they're lending on. I want to see personal capital from the operators invested alongside the limited partner. I want to see a verified track record, clear reporting and communication. I want to see all those same things on the process side of things. Okay. Documented underwriting standards, independent property appraisals. Okay. Or, brokers' price opinions are cool too, but I'd like appraisal even more. I want to see their monthly borrower monitoring process. Okay. And I want to see all their workout procedures. How are they working with the borrowers that are getting into trouble? For me, safeguards, first position lien, 60 to 70% loan to value. I want to see personal guarantees from credit-worthy borrowers, meaning if the borrower defaults and there's a gap between what the lender can sell the property for, say like there's a 10K gap, the borrower's on the hook to make everybody whole. So the investors aren't left, hanging out to dry. And then again, multiple contingencies for exits. Now, again, I wanted to provide value to you so you can take a look at our fund, right? The metrics of our fund and really understand that we really truly try to put together a product for investors that is conservative. And I know that word gets thrown out around pretty ad nauseum, right? We're probably all tired of hearing the word conservative, but that we actually try to put together a very well-protected fund that has our limited partner truly in first position and really making sure that everybody's interests are aligned. So for our fund, we do a first position lien fund. Okay, we love non-judicial states, meaning when we are lending on residential single family fix and flip real estate, that's kind of our bread and butter. We love the non-judicial states. Okay, it's easy to do some workouts with the borrower without having to go through the foreclosure process. Our asset class, we love single family. Everybody needs a roof over their head. That property can go to owner occupied. It could go to another investor. It could be flipped. There's so many different ways to exit a single family rental property. Our development phase is fix and flip. Okay, so there is a little bit of a time period where the asset is being stabilized. That's why the borrower is coming to us, is to get access to monies to not only purchase the property, but get a little bit for construction too. Now, this is where we blow the doors off our competition, is most debt funds will only have 60, 70, maybe 100 loans in their portfolio at any given time. Our fund stays at about 450 to 460 loans. We're not really looking to grow that number, exponentially right now. That's kind of a sweet spot for us. But that gives the limited partner, you, an opportunity to be diversified across multiple borrowers, markets, and deals. Our distributions are monthly, or you can allow them to compound. Another place where we really differentiate ourselves is the default rate. The industry standard in the fix and flip space is about 3 to 10%. Okay. So that means when an operator or a lender, originates that loan, they know about, 3 to 10 out of 100 loans that they write are going to have some sort of trouble. All right. We aim for 0. That's what we want. We aim for 0. We're hitting at about 1% right now. Deficiencies, 0 deficiencies to the fund. Okay. Other operators will have a way that the borrower can exit out a different way. But we're not looking to solve the problems for our borrower. We don't want the property back. We just want our borrower to pay the interest and exit the loan. And so we look to source borrowers that are on that same business plan with us. Lockup and redemptions. For investments under $500,000, there is zero lockup on our fund, meaning you can invest your money today with me, and once it's deployed, you can say, Whitney, I need my money back. And I have a redemption period in the PPM, it says 90 days to get you your money back. For investments under $500,000, our typical redemption is, 14 to 21 days, oftentimes less than that. We do zero leverage on our fund, meaning we don't get a bank line of credit and make our limited partners actually be in second position behind the bank. All right. This seems like a really good thing, right? When you talk to debt funds and they say, hey, I can get you your money back in 2 days if you really need it. The next question you should be asking as a LP is, what type of line of credit do you have on the fund? What kind of leverage? And oftentimes you're going to find that they have somewhere between 20 to 50% leverage on their fund. Okay, so you're no longer in first position. You're actually behind the bank. All right, we don't do any leverage. We keep our investors in first position. And then break-even performance. This is another due diligence criteria for you to take a look at. How many loans in the fund have to perform before your preferred return gets affected? Okay, most funds are somewhere between 65 to 80%. Ours, we'd have to see 50 to 55, 45 to almost 50% of our loans would have to be non-performing before our preferred return got disrupted for our limited partners. So again, why the PIC Real Estate Debt Fund? Why does it fit the moment that we're in? Again, we're trying to build out that stable income leg of that, three-tiered portfolio stool, if you call it, right? The predictable income, safe, flexible, liquid. We can allow it to grow, but that keeps us patient in this environment while we wait for the other equity deals to come on board. We stay in first position, lean and secure. There's built-in diversification into the fund. Another thing is we have a true preferred return, meaning we treat our limited partners as the bank. You get paid before any expenses to the fund get paid, which is very uncommon when it comes to debt funds. Flexible distributions, you can either take the monthly income or if you want to, allow it to compound and grow, that is your choice. And then we got the liquidity provisions, no lockups for investments $500,000 or under. So again, here's kind of our layout. And one of the questions I usually get is, where are you primarily invested in the PIC Real Estate Debt Fund? Again, our operators, our managing partners and our operators have 51 years of combined experience lending in fix and flip real estate in North and South Carolina. It's very specific experience. And, two of our operators have been lending in this space since before 2008. So they know, they know exactly what happened in 2008, 9, and 10. And they're like, we're not repeating that. We're not going there. Okay. Again, we do short-term 6 to 9 month loans on fix and flip property. We've originated over 2,250 loans. We have somewhere between 450 to 470 at any point in time that are active. And we have an average maturity period of between 6 to 9 months, right around that 208-day mark. Our loan to value is 60 to 65%. And our borrowers love us. So we have an over 80% return borrower rate, which is amazing. We want to, it's easy to continue to find one customer, develop a relationship, and continue to lend with them again and again. Zero fund efficiency is very low default rate, and zero fund leverage. Now, for my peeps that are really wanting to, they're like, Whitney, that's great, cash flow, awesome, but I want growth. This is where kind of the magic happens, is you can allow, this is a case study on a $100,000 investment. In a $100,000 investment, it hits our 8% return tier. If you just allow it to compound, in 10 years, it's a 17% internal rate of return. Now, does that match the 5-year return that you might get in an equity deal? No, I understand that. Again, this is a different tool in the tool belt. You can really, again, understand that you can grow through compounded growth. All right, so I know we had several questions. Interest rates, what does it look like? Here are different tiers. To open your account, it's $25,000. Between 25,000 and just under 100, it's a 6% preferred return. Now you can add in increments of $1,000. I personally love this for retirement accounts because self-directed IRAs, because it's really hard to stuff that money in there and then like save up for like 4 or 5 years and then go into an investment. Here, you can actually use this to compound and grow your equity faster by continuing to reinvest your cash flow. And then whenever you get your, 30, 40 grand that you need for your next single family rental, if that's what you really want to do with your IRA, you could liquidate and then, move out if you want to. $100,000 to just under $500,000, that's an 8% preferred return. 500 to just under $1 million is a 9% preferred return, but it does come with a 6-month lockup. And then $1 million invested or higher, you can take a 10% preferred return with a 1-year lockup. All right, now the elephant in the room, I want to make sure that we address before we open the floor to questions, is again, I usually have the people that are like, okay, Whitney, you convinced me. We got cash flow. I understand that I need to probably add this into my portfolio. You got me with the self-directed IRA. This actually looks pretty good for my self-directed IRA. But taxes, what about the tax man? I don't get any depreciation. Well, that's the thing, is that we need to, if we're going to structure an all-weather portfolio, to borrow Ray Dalio's words, we need to stop thinking of investing in one tool, like an equity investment, and expecting it to do everything to provide diversification, cash flow, equity growth, and tax benefits. We need to start looking at this across our portfolio. Now, so one, debt funds definitely are not going to be your tax optimization tool, but it is your income stability and predictability tool. All right. There are other ways for you to leverage tax optimization with your other assets. So again, this is not an either or, equity or debt. This is an and approach. All right. So the real payoff with the debt fund, and we'll open the floor to questions, financial security, start building up that income generation engine. That way you don't have to, how many people here are invested in equity deals and probably had, if they all were performing, had enough cash flow coming in. But you're just one deal away from cash flow being paused, or your tenant leaves your rental property and now all of a sudden you're like, your cash flow drops, right? Does that make you nervous? If that makes you nervous, this is a great case to add in that debt fund predictable cash flow layer. Time efficiency. Okay, you can be very efficient, right? I actually, for the group that I presented to last week, I should have dropped the numbers in here. I actually, in session, did the math with everybody. And I said, if you just sat on the sideline 1 year in an equity deal, say like and you were waiting for the perfect multifamily equity deal, you actually would make more money being in a debt fund than you would if you sat on the sideline 1 year in an equity deal. Why? Compounding, compounded growth. Okay. Awesome. So who's the debt fund for? I say for everybody, but especially if you're sitting in cash, wanting income without the high risk. People that are closer to retirement, this is probably speaking to you. Or if you're waiting for equity opportunities and you need to keep your money earning, the PIC Real Estate Debt Fund is a great strategy for you. Now, Daniel, I know we have tons of questions. I wanted to leave a few minutes available for us, but again, this is your call to action. If something I said today really resonated with you, hit me up. Join me at passiveinvestingwithwhitney.com and let's hop on the phone together. You'll get, again, access to our deals, but more importantly, I would love to, have the opportunity to discuss like how we could best support you.
Well, Whitney, those are some of the some very investor-friendly terms on the debt fund. That's really great. I love to see that sort of thing. Um, let's jump into the questions. Okay,
Let's
and
do
we've got
it.
quite a few here. And so I'm going to take these in order. So these are the questions that came in more towards the beginning of the talk. And if you have additional questions, go ahead and throw them in the chat. For everybody that's out there, go and read the questions that are in the chat and put a thumbs up next to the ones that you want to see. Make sure that we get to. So, and yes, William, clap for Whitney. Thanks. We'll actually do that in a moment. um, William is asking, what is the range of interest income that you should expect? And you
So
did show the chart at the end, but go ahead.
yeah, no, so the easiest way here, we have never missed an interest distribution to our investors ever. Like, and we founded the fund in June of 2020. Uh, so we actually really thought, yeah, I mean, I hope everybody remembers what happened in March of 2020. But yeah, so we actually launched it in a pretty trying time in the market. Anyways, 6% for investments 25 to just under $100,000. You can add in increments of $1,000. So it really allows you to put every dollar to work if you really want to. 8%, 100,000 to just under 500,000, 9%, 500,000 to just under a million, and then a million or more, 10%. That 9% tier and 10% tier do come with lockups. You don't have to take the lockup. So you could have $500,000 invested and take a lower tier if you don't want to have a lockup.
Okay. Okay. And I think you also answered the question of what the minimum investment is here and being able to add incrementally like that. I mean, go ahead and reiterate that. That was the other debt funds that I've seen are often, 100,000 or even $200,000 minimums. And
Yeah.
so this was pretty different.
So I'm going to tease something here, and I hope everybody's listening, get everybody's attention back. Our Regulation A fund, we're about to open momentarily, like in the next month. It's going to go into our debt fund. And so for those people who are like, "Ooh, $25,000, I don't have that in my IRA account or whatever." Like there will be an opportunity, one, for sophisticated investors to get into this opportunity. So get on my list and let me know that that's what you want, and I will get you the information ASAP. And two, it will also, for my accredited investors that are like, I don't, I want to come in at a lower amount, that'll be your opportunity too. So if you're sophisticated, we're about to solve that issue for you. If you're accredited and you're like, I don't have 25K or I don't want to do 25K, we're about to solve that issue too.
All right. Fani is asking, are debt funds backed by any institutions? And I asked her a little bit of an elaboration on this, and they said, yes, like a bank or like FDIC, like FDIC is for a bank. So what are the backings for
This is not
debt
a savings
funds?
account. This is not a savings account. This is a private equity investment. Okay, so not a savings account, please. I have a lot of people that do use it as a savings account. I'll be really honest. I have over six figures, multiple six figures in our own, real estate debt fund. So I put my money where my mouth is, literally. Um, but I even don't use it as a savings account. So please do not invest your hard-earned reserves here. This is where you need liquidity, cash flow. There is no FDIC insurance here. So, what is it backed by? The fund invests in fix and flip real estate in a first position lien. So it's backed by actual notes on real estate.
And is it collateralized or non-collateralized?
The fund holds all the collateral notes, right?
Yep.
Yeah.
Oh, okay. So yeah, there's not an FDIC insurance, but it is first position liens that are collateralized. Okay.
Yeah. And our borrowers give a personal guarantee.
Okay.
Mhm.
Let's see. Fanny also asks, is the debt fund similar to P2P lending, but applied at a business level, not institutional levels?
I mean,
So
that could
would you
be
say
one way
this?
to look at it. Maybe. I
Yeah.
mean, we aren't, so again, and I saw a lot of these questions came in well before I started getting into how our fund was structured. But passiveinvesting.com, we raise the money. Our sister company, Rehab Wallet, we're owned by the same managing partners. Rehab Wallet deploys the capital. And then that money that Rehab Wallet brings in, they pay the fund distribution first, as it says here. Investors receive their preferred return first, and then they pay all the other expenses related to running the fund or
Okay.
before they distribute or profit to the companies.
Okay. Brooke is asking, as a debt fund manager, how and where do you find your borrowers?
Yeah, honestly, if I could go back to this, I'm going the wrong way. This way. Um, so our managing partner, Kelly Garrett, and our director of operations for Rehab Wallet, Angela Dunn, they've been doing fix and flip real estate for almost 25, 30 years individually in these markets. They, started off in Charleston, South Carolina, and then moved to Columbus, and then, out to Greensboro, and then expanded into North Carolina. This is largely built off of their own personal network. So we do market, we do go to conferences to find borrowers, but largely it's kind of like word of mouth, local RIA groups. I mean, they've built a strong business. And then couple that with our 80, over 80% return borrow rate, like that's awesome.
Okay. Adi is asking a question. I guess not necessarily about what you're doing, but they are asking, are there any publicly traded real estate debt funds?
I'm sure there are. I just don't know, nor am I, here to talk about them, but I'm sure you could,
You're like,
if you
there
went
are
into public
mortgage
equity.
trusts, things like that.
Yeah, I don't know of any offhand that would offer the same conservative underwriting or assurances that we do, but I'm sure there might be something out there. But here's the thing. I mean, my question then comes to if, you know, one, we're going to have the Regulation A fund. So if you were looking to invest a smaller amount, if that's why the stock market's attractive, then, again, we're going to have that issue solved. So make sure you get on our list so we can notify you. Um, Two, this gives you greater transparency than I feel like going into a REIT. I will tell you, I have a beef against REITs. When my mom passed away, her financial advisor had her in like five different REITs. Um, it was horrible trying to exit those REITs, and all of them came at a loss. So if I did any REIT, it would only be on the stock exchange. Like I would not allow my advisor to ever put me in any REIT. That's just me. I'm sure somebody has a story that is positive. Mine is very negative.
AB is asking, you mentioned that debt funds can be structured to deliver equity-like returns. Could you share how you've seen a debt offering structured to get a 1.6 return? Are these through
Compounding.
warrants? Are they through PIK interest or schedules, etc.?
Yeah, and I saw that question come in. Honestly, like it's compounding. Are you really the magic of it? So an equity return is that when we go into an equity deal, we're hoping to shorten the timeline of investment to where we can compress time and then also force the valuation in the market. Meaning I buy a property below value, I complete a rehab or some sort of business plan, and then I can exit earlier in order to capture future appreciation, right? Or maybe past appreciation, right? If we're doing a rehab piece. But, in a debt fund, you don't own the asset. You own the note on the asset. So you're the bank. You're just getting interest. So how do you get an equity-like return? Keyword here, like. You have to allow time to work. So one, capturing the higher interest rate tiers and then allowing it to compound, right? This is just our 8% tier. I don't have it in here, but like if you invested in our 9 or 10% tier, this 17% gets pushed up to like year 6 or 7. I mean, I have multifamily investments in my portfolio that aren't going to exit at 17% IRR when they do, like from this like last 5-year vintage. So, for my people who are risk averse, great. This is an amazing opportunity to capture an equity-like return. But also think about it, if you're really wanting to continue to build on the equity side of things, this just gives you an avenue to remain patient, right? You can capture some upside in the next 3 to 5 years while you deploy capital, into other equity deals. I will tell you, when I start liquidating some of my debt positions to go into equity positions, I'm going to be very intentional with it. I'm going to cap myself on the dollar amount per year that I invest. I didn't do that very well. I got a little overzealous in a couple years. Fortunately, I'm okay, but it was by sheer luck, not intention. But that way I can kind of dollar cost average into my equity positions and take advantage of all different parts of the market cycle.
All right. I see that we have some really good questions that are left, but we've got less than a minute left here in the meeting. And so if you have these questions here, make sure that you contact Whitney. Where's your contact information, Whitney?
Oh,
All
I'll get
right.
it right up here for you.
All right. And I guess, as a last question here, is the fund open for sophisticated investors or only accredited?
Currently accredited. In the next month or so, when we open the Regulation A, it will be sophisticated investors.
Right, right. Okay. Hey, everybody, could you take yourselves off of mute and thank Whitney for coming in and speaking to the Alternative Investing Club today?
Thank you, Whitney. Thank you,
Thank you,
Daniel.
Whitney.
Thank you,
You.
Whitney.
Yeah,
This
it's
was
my
so awesome.
pleasure. Thank you.
Come back again.
I'll
Thank
see you in
you.
If you do
January,
that, you'll
but
be
you guys.
the person who's spoken the most, not just tied.
But yeah, reach out to me. I would love to connect with everybody individually. I know there's some great questions on like fund
There
manager
are some, yeah.
compensation, but everything that I showed to you is net. So that is your return net. Like we don't make people do mental gymnastics or math. So
I'm going to save the chat just so we have it because there are some good questions here. All right, everybody. Thank you so much for coming in. We will be back next Friday. And until then, have a great weekend and a wonderful week. Thank you, Whitney.
thank you. Take care.